In lesson 1, we define catalytic capital, describing what it is and when it is used, and why investors include catalytic capital in their portfolios. Let's start by introducing the topic. Catalytic capital is a subset of impact investing that addresses capital gaps left by mainstream capital, including gaps left by impact investing that seeks primarily risk-adjusted financial returns, in pursuit of impact for people and planet that otherwise could not be achieved. Catalytic capital investments are defined as debt, equity guarantees, and other investments that accept disproportionate risk and/or concessionary returns relatively to a conventional investment in order to generate positive impact and enable third-party investments that otherwise would not be possible. I have highlighted a few words in this definition. First of all, the and/or relationship between disproportionate risk and concessionary returns relatively to what the purely commercial investors will do, and the positive impact that otherwise will not be possible. Let's look at each of these elements in greater detail. Starting with disproportionate risk. This can take various forms, including investing in difficult markets or unproven solutions, such as serving beneficiaries that live at the bottom of the economic pyramid, investing in frontier markets, invalidated technologies, and unproven business models. Extending your timeline as an investor by being more patient and accepting an uncertain duration, being flexible with the deal structure or new terms. For example, you might invest in revenue-based financing transactions that enable a company to repay the investments based on their business cycle, or a lack of track record, benchmarks, and reference points. With regard to concessionary returns, we're referring to instances when the investors is willing to accept lower expected returns compared to what investors motivated only or primarily by financial returns would accept, which we shorthand as commercial capital. This can be achieved by accepting below market return expectations on equity or sub-commercial rate of returns on debt. Please note that there is an and/or relationship between these two elements. They may or may not occur together at the individual deal level. However, they almost certainly do occur together at the portfolio level. What this means is that in practice, you may perform a catalytic capital investment that presents disproportionate risks that may still turn out to be a financial success. However, if you build a portfolio intentionally targeting investments that present undercompensated risks, this will inevitably lead to below market rate return at the portfolio level. Catalytic capital investors know that and intentionally accept it in pursuit of greater impact. The other important element of catalytic capital investments is that they have distinct investor contribution. In other words, the investment creates impact that will not be possible with commercial capital alone. Sometimes you may also hear this concept described as impact additionality or counterfactual impact. They are similar concepts, but imply some sort of quantification. Investor contribution is a broader term. We will return to this concept momentarily because investor contribution is one of the greatest factors motivating investors like you to deploy catalytic capital. You may also encounter other terms with meanings similar to catalytic capital. Impact first means targeting the desired impact and accepting financial returns appropriate to depth of impact. Sub-commercial or sub-market focuses on the financial aspect of these investments, but does not highlight the extra impact achievable, which is one of the reasons we prefer catalytic capital. Flexible capital is similar in meaning to catalytic capital. We have settled on catalytic capital as it is a term being embraced most widely in the field for this approach. It's also important to highlight what catalytic capital is not. It is not impact investments that seek risk-adjusted returns. It is not grants where the investors are expecting no returns. As a matter of fact, grants lay outside the definition of catalytic capital, even though they may play a very important role in enabling catalytic capital transactions, especially for early-stage capacity building. And catalytic capital is also not synonymous with blended finance, which is rather a way of structuring deals that includes catalytic capital investments.